Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We are back on FedWatch today, folks, at a very interesting time for the financial markets when the market's own Fed perspective seems to be in flux. We have with us tomorrow the publication of minutes from the Fed's May policy meeting, which is ostensibly the meeting where the Fed has, according to general consensus, changed its tack and paused the rate hike cycle. It seems, though, that the consensus to do that might have been a bit precarious because, of course, the language seems to have changed a little bit, where the straight call for more tightening was removed, and instead the idea that policy is cumulative and will bring tightening that is absorbed over time, even as rate hikes have paused, because those actions that have already been done still need to be fully absorbed. Nevertheless, policy officials, since that announcement, have come out and said, well, maybe actually we need to do more. Maybe we need to do a further 25 or a further 50. And the recent moves that we've seen in markets seem to suggest that at the very least, investors have started to reduce rate cut expectations that they had built up. And so how these minutes that come out ultimately paint the story of a Fed that's trying to balance what's going on with the business cycle, the debt ceiling debate that was less encouraging than at least the markets seem to think it is now, although no significant movement is confirmed, and a banking crisis that was simmering. That will be very interesting. And what we're going to do here is we're going to look at how the markets are positioned for it and how then they might react depending on what comes out. So let's consider, first and foremost, current conditions. So we have with us a situation now where Fed rate cut odds appear to be narrowing. So consider here in the dark line is the implied rate in Fed funds futures in June. You can see it hasn't really moved off that 5 to 5.25 range, so no hikes being expected there. But you can see the December curve, so where we are at the end of the year, has been pointedly rising. And so now the amount of cuts implied by looking at the spread between where we're going to be in June and where we're going to be in December, that's been getting smaller. That's those gray bars getting shorter. You can see that arrow is pointing up there. That is telling you that the markets went from expecting anywhere between 100 to 75 basis points in cuts for the back half of this year, as recently as the beginning of this month, are now expecting maybe between 50 and 25 basis points in cuts. And so there has been a shift, a quite significant shift of between 50 and 75 basis points toward a less dovish second half of 2023 for Fed policy. How have the markets responded? Well, consider the evolving relationship between stocks and rates. Most recently, we can see in May, stocks and rates are going up at the same time. This is as fundamentally different from what we saw back in February, where the last time we had a meaningful build in the Fed policy outlook there, you can see the red lines going up. Stocks did not like it. They were going lower. And that's seemingly because the thought was, well, if the economy is heating up, then the Fed is going to have to hike more. Then we are likely to see a greater hurdle rate on investment, a greater financing cost for economic activity writ large. That's bad for consumption. It's bad for earnings. It's bad for equities. This is a very different situation. We can see they are moving in tandem. What's more, the dollar is also rising in this environment. So we could see as Fed policy expectations rise, we are also seeing that we have a stronger dollar, which again clashes with what we were seeing back in February, in the sense that when the dollar was rising with Fed policy expectations, then, as we just said, stocks were falling. Now, stocks, the dollar, and the Fed outlook are all moving in the same direction. That seems to suggest that there's something other than the business cycle that's afoot here. It doesn't appear as though the market is necessarily saying, oh, things are going to be good on growth, and so the Fed is going to have to do meaningfully more on tightening. Rather, it seems to be that a degree of weakness or instability that reflected the amount of cuts that were there, at least at the beginning of this month, that is being downgraded. And perhaps that is the debt ceiling resolution being something that the markets increasingly think is going to actually occur and give us something that isn't very disorderly in terms of its headwind impact from a fiscal side on economic growth. Let's remind ourselves briefly that the idea that the U.S. is going to default as a concept to be priced into markets is really a non-starter. You can't go and price in the default of a sovereign whose debt is the risk-free asset benchmark for international financial markets writ large, with perhaps North Korea as an exception, perhaps Russia now as an exception, perhaps Iran as an exception. But for the most part, the go-to risk-free asset in financial markets is U.S. government debt. And that's built into derivatives and all manner of financial contracts all across the world. It is also important to remember that the U.S. dollar, as of the last set of numbers from the Bank of International Settlements, continues to be counterparty to 88% of global monetary transactions. And so it is overwhelmingly the currency of exchange for global business. So if you were to price in a scenario whereby the U.S. defaults, you would be saying that the faith and credit of the U.S. government is no longer something that underpins the dollar, the transactional currency for commerce, and not something that underpins U.S. Treasury bonds, the risk-free asset for financial markets. Well, that makes it such that you couldn't really price that in, because to have such a scenario would so fundamentally change current market structure that it wouldn't just be a pricing in, it would be essentially a hard reset on the entire system. So that isn't ostensibly what we're looking at. That isn't the object of speculation, because it's simply not viable. What probably is the object of speculation is that a deal is done orderly versus disorderly, and the extent to which there has to be some fiscal tightening that a deal brings up, regardless of which one it is. If it is an orderly thing, then we probably have to forego some spending in the deal. There's probably a degree of tax increase that has to get offset in that balance. So you probably have on net some amount of fiscal tightening that's coming if there is a truly bipartisan, mutually acceptable kind of deal here. If there isn't one, and the Treasury has to actually start to think about which bills to pay and which bills not to pay, well, then there's a retrenchment on government spending that then becomes a much harder, much more impactful fiscal drag on growth. And it is that outcome that the markets seem to be pricing out here. which is why you seem to be getting a stronger dollar, a less dovish Fed outlook, and stronger shares all at the same time, as fundamentally different from what we've seen before. Consider here that the markets still generally think that the Fed is broadly on target with inflation. So even as rate expectations drift higher, the 2-year break-even rate here is only a touch higher. So that, of course, would be consistent with a fiscal headwind risk being removed and growth perhaps being a little bit faster for it. But as you can see here, the 12-month Fed funds future implied rate still looks to cuts as relative to now. So in a year from now, it looks like we're going to be down about 100 basis points from where we are currently. If we're in a 5 to 5.25 range now, and we're going to be at about 4.3, so call it 4.25 to 4.5. Leaning toward 4.25 in a year from now, according to markets currently, then we still have about 100 basis points in cuts over the next year, and inflation, while a little bit higher than the 1.9 setting on this 2-year break even that we saw at the beginning of this month, still very manageable at 2.1. Still suggests that we're going to get broadly on target. Very tellingly, we can see that the Fed policy curve has barely budged. It's a little bit more hawkish toward the 1 year, the 2-year mark, but just barely so. We have very little movement in the current curve as relative to when the last FOMC occurred on the 3rd, as relative to a week ago. And so really capturing most of the month, there is not a whole lot that's changing here, which again sort of reinforces the idea that what we're seeing in markets is more about event risk, this debt ceiling situation being de-escalated in the eyes of markets, then we are seeing a broader upturn in the business cycle, which of course is likely to get reflected in those FOMC minutes and the logic in pausing rate hikes. So that logic lays out fairly straightforward. We can see that the overall direction for U.S. economic data has been to surprise on the downside increasingly over recent weeks. In fact, we have here the City Economic Surprise Index as well as its 20-day moving average. We can see that it is now actually descending faster than the 20-day overall sort of trajectory, which has now turned broadly down. So the general sort of thrust of U.S. economic data is toward weakness. And this is, as we've argued before, is because disinflation is now a growth slowdown story rather than a squeezing out of efficiencies story. Of course, we've been back and forth extensively around this idea that some parts of inflation were always going to be what the Fed called the transitory inflation bit, and that's from increasing efficiency of supply chains, rematching suppliers with customers once COVID reopening really took hold around more of the world and supply chains locked back in. Once substitutions for some markets that were closed longer, and of course China stands out there, once those are made, and of course, once some of the pressure on supply chains is reduced by the Fed's own tightening actions and other central banks' tightening actions, that the part of inflation that was there because of supply considerations, because demand couldn't quite get the supply it needed in time, and so there was a bidding up on costs, that part of it is essentially squeezed out of inflation already. We can see that the Baltic Dry Index of shipping costs has been following lower really since about the middle of 2021. We can see that distributive service inflation, this is wholesale prices for the actual distribution of both intermediate and final goods in the US, the growth rate there has dropped to just a hair above zero and right back down to where it was before the pandemic. So that part of it seems to be at this point squeezed out. So now, to get to the next between, let's call it 2 and 3% of inflation pulled out of the market to give the Fed its 2% rate, between 2 and 3, depending on if your benchmark is CPI, which is closer to 5, or PCE, which is closer to 4, that further disinflation looks like it needs economic weakness, which of course is exactly what the Fed has been telling us. And by all accounts, that economic weakness is occurring. So here we have the latest ISM numbers. We have both services and manufacturing. We can of course see that services has been doing a bit better, manufacturing a bit worse. But the overall direction of travel for economic activity in the economy is toward deceleration. We can see it in labor markets, where inflation being squeezed lower is now coming at the expense of a narrowing mismatch between labor supply and demand. So those blue bars being below zero suggests that labor supply still is insufficient for labor demand, but what you see is that the trend has been tightening. And so now demand and supply are less, as it were, offsides. In fact, that gap is the smallest it's been since September of 2021. So we're looking at a situation where there does indeed seem to be a deceleration now as the main catalyst for bringing inflation down. We're going to get these prices lower because the economy will be weakened by higher borrowing costs. Weakened not accidentally, but as a point of policy. Just today, there was a little bit of a bright spot in this narrative. We saw here that the services and thereby composite PMI numbers registered fairly strong. In fact, you can see here services looking as firm as they did almost a year ago at this point. Composite looking similarly strong, but of course, manufacturing dipping further into contraction territory, and the overall direction still very much lower from the peaks back in early 2021. So again, that deceleration still continues, and the likelihood that we've turned a meaningful corner here, probably not great. So further deceleration probably in the cards, because while services here certainly looks like a bright spot, leading consumer confidence data suggests maybe not for long. If external demand, as captured in manufacturing, is struggling, and domestic demand is being underpinned still, and this is why services is still relatively strong here, then the downturn in consumer confidence speaks to that changing as time goes on. And so it's important to consider because indeed the expectations component of this and composite PMI tend to lag by about a month or two. So it does seem like there is a headwind that will keep the pressure and the down move in business activity intact here, to today's data notwithstanding. Looking at a catch-all here, we can see that indeed there is an expectation in markets that the Fed will be ultimately successful. This is very different from what we saw back in February, you can see then we were looking at a 2-year break even at 3.2. And so, not surprisingly, this again was the dynamic. With a break even at 3.2 and growth accelerating, what we are getting from the markets is we have to have a Fed that will do more to hike rates because inflation is clearly a percentage point and more off from where the Fed wants it to go over this 2-year period. That's fundamentally different from what we saw and what we see here currently. Now, we have a situation where the break-even is at 2.1%. So a full percentage point and then some lower than it was back in February. And what we then see is the market being able to digest this upshift in policy expectations, ostensibly because it is episodic, because it is marking the unraveling of some event risk linked to this debt ceiling situation, rather than a genuine upturn in the economy that then beckons further tightening. We can see that the markets for now are relatively sanguine. So that's the financial stress index. You can see it is idling here, even as Fed policy expectations start to edge up toward the top of their post-SVB range. But importantly, it's worrying to look back and see that until there is a problem, the credit market doesn't seem to really seize up. So it's not as if we had back in February a rise in policy expectations that was met with deteriorating conditions. We can see that conditions were in fact idling as those expectations were getting more hawkish. It took for there to be a bank failure for the stress index to jump and for policy expectations to crater. So what we're looking at now may well be something that's similarly lagged if policy expectations build meaningfully higher. For now, it looks like they're still confined within the recent range on the 12-month outlook, roughly oscillating between 3.5 and 4.5 1 year forward. But if we were to get something higher, we might get another pickup in credit stress and loop back to where we were in February. For now, that doesn't seem to be the case, and the reason isn't something that markets necessarily have reason to take solace in. Rather, it's that the markets don't think that there's going to be meaningfully more tightening out of this, perhaps fewer cuts, and it's because this economic downturn is still building in the pipe. It's still something that's emerging on the horizon. We can see in the reaction of risk here, then, that it hasn't really moved as these policy expectations rise. It has more so held near this kind of, let's call it 41 to 42 range on the S&P. We poked above it a little bit in recent days and have since slid back down. We can see that slide back down consistent with Fed policy expectations building. So for now, it seems risk is not prepared to be worried about another scenario where building Fed policy odds crack risk. And if we kind of pull these charts together, we can see why that is. At this point, it's not creating a sense of consternation. So while credit stress remains anchored, risk remains anchored. However, this then speaks directly to what we might get in these FOMC minutes. If the sense from the minutes, which speak to a meeting that occurred at the beginning of this month when, we'll recall, the markets saw a need for between 175 basis points in easing because ostensibly this debt ceiling situation and other risks just coming out of the banking crisis was certainly part of this calculus as well, it seems, that we're going to need to really give the economy more support, that the Fed has over-tightened, that we are now moving in a direction where some of that risk is being taken off the table is for now seen as benign, it looks like, by markets. But if those minutes suggest that when the Fed was looking at this calculus back in early May and said, we're okay with pausing here, we think there's enough economic weakness given the risks, but if one of these things ends up being an upside surprise, we might have to do more. We're not disinflating fast enough if one of these headwinds goes away. Well, then you might get into a situation where, similar to here and what we saw in February, we might start to think that maybe we have another situation where the Fed risks over-tightening and a rising Fed outlook starts to pressure risk. It may likewise simply be the case that the markets, with this level of consternation removed, start to think more as they did on the way immediately out of the banking crisis, which you can see right here, where Fed policy expectations were weakening, as was risk. And very, very tellingly, at the same time, the dollar was rising, as different from the current environment. That would speak to worries, once again, about the global business cycle, rather than episodic headwinds or a policy mistake on the fiscal side, be it from the debt ceiling or some other thing. So what we're looking at here then is a very fine balance that might be struck in these minutes. And if the tone upsets this balance, whereby risk sentiment seems to, for now, be okay with what's going on because it is waiting for this risk to get squeezed out and is happy that it is being squeezed out because, of course, equity markets don't like fiscal uncertainty, and so is willing to countenance this without significant risk aversion because it looks like inflation is still on track to get to where it's going without much more tightening. If instead it looks like the removal of the debt ceiling risk, at least in the minds of Fed officials, is something that would likely warrant more hikes, if that's the narrative, we might be back into a situation that feels more like February. If, on the other hand, it seems like the Fed is reasonably okay with the current environment, then we might instead get a shift back in the direction of worrying about the business cycle and whether it will be enough. In other words, the deal being done will essentially be something that's priced in, not fully until it's final, but at least from the Fed's perspective, the markets will conclude that the pause occurred independent of those risks. And that, of course, speaks to headwinds for global growth gathering ahead. So all taken together, the danger facing markets in the best case scenario are that we are going to go back to something that looks mostly like this. And the outsized risk is that we get to something that looks more like that. In either situation, however, the net beneficiary seems likely to be the US dollar. It seems unlikely, although certainly possible, that we get to a situation where the dollar makes out poorly in this balance, whether we go to one or another set of sequencing settings for stocks and overall risk appetite as relative to what the Fed outlook is now that policy officials have signaled a pause for either the one reason or the other. And that is Macro Money for today. Thank you very much for joining me. As ever, I am here Monday through Thursday, just after overtime, a show that I do with a friend of the show, Chris Vecchio, head of Futures and Forex here at Tasty Live, where we break down the day's events across markets and try to make sense of them. I'm also on with Chris for Futures Power Hour on Fridays, and then on with Tom and Tony for First Call on Sunday evenings. Outside of those shows, I'm opining about markets on Twitter at Ilya Spivak. Good luck out there, everybody. Speak to you tomorrow. Take care.